We got a great webinar talking about directors and officers insurance. And when I talk with some business owners and clients of mine, this is probably one of the most misunderstood coverages and exposures in talking of any coverages. So, there are a lot of great topics out there to talk about and provide some information on, but we want to take some time today to talk and dive specifically into management liability and more specifically in the directors and officers exposure and coverage, so you can better understand what your exposures are, and also understand, many of these insurance policies, they're different from one another, so what to look out for when reviewing the coverage. So what better resource and person to describe some of this and claim situations, et cetera, than Drew Kinner over at Hanover Insurance. So Drew is the management liability underwriter on a national level for Hanover Insurance, and many of you all probably know Hanover Insurance. They're one of the largest insurance companies and have thousands of employees. So Drew's been doing this for a number of years, and he's probably he is in my opinion, the most knowledgeable and passionate person about management liability. He's my go-to when I have a question about this, and plus he's seen a lot of real life examples where he can kind of paint the picture a little bit better for you to understand, why it's so important for your specific situation, and I think you're going to get a lot out of it today, and we're real excited to have Drew as a speaker on this. Drew, if you want to take it away from here.
Sure, Mike, thanks. First, thank you everybody for joining us. I do appreciate the time you're giving me today. I know not everybody's as excited about his insurance as Mike and myself, but I'll try to keep this short and as informative as possible. I want to let you know a little bit about my background. I've been underwriting management liability for over 12 years now, and I've been with Hanover for 5 years. Recently, I moved out of a desk underwriting role, handling a territory to handle and manage all of the human services management liability for Hanover. So it's something that I do love, and I'm still learning every day. And as Mike said, I am pretty passionate about it. Before we get started, I just want you guys to take a quick look at the screen. This is Hanover's disclosure. Take a moment to read it. It is really meant to inform you that this is not a determination on any coverage. It's not intended to be advice on any claims or any coverage offerings. You should always speak to a licensed agent prior to purchasing or reviewing any coverage. All right, so today we're just going to look at D&O. Directors and officers is typically bought in a management liability package that includes D&O, employment practices liability, fiduciary, kidnap and ransom, sometimes crime and cyber are thrown in. But today we're just solely going to look at the D&O portion. We're going to look at what the coverage protects against. I want to really give you guys an understanding of the potential liability that exists, and where your current policies may fall short. So we'll just run down the importance of coverage, the role and responsibility of your board, who's covered, what's covered, where do the claims come from, and then we'll look at kind of the types of allegations and some claim scenarios. And then we'll go back and Mike can kind of look at your current coverage and the gaps that may exist for you. All right, so first, when we want to look at the importance of coverage, I always say the number one most important reason to buy the coverage is to protect your board, your executive team, and the company's financial assets, right? So as a board member, your assets are exposed every day for the decisions you're making. Your house, your cars, your bank accounts, your retirements, everything's in play. The coverage was designed to protect your personal assets, and that's where we'll start. Whether you made a mistake or not, whether it's frivolous or not, there will be suits, and they can be costly. Even if you have indemnification by your organization, it doesn't mean that your organization has the funds to to go through a true D&O suit, especially some of the more costly allegations. The cost of defense alone can truly cripple an organization and deplete the assets of the organization. So coverage is really important. I have up there to help with regulatory audits and inquiries. I have an asterisk there because carriers view this differently. But when you have an audit from a regulatory body, it's always good to get your carrier involved. They may say, hey, this isn't a claim. Let us know when you reach this point, right? So we know when a regulatory body is doing a true audit and when they're fishing because they think something is up. I mentioned the cost of suits. Defense and indemnity payments are truly, why you buy the coverage. But people forget and don't always think about the appointing of appropriate counsel. We defend companies like yours every day and in every venue in the country, right? And the courts in California are different than the courts in Texas, are different than the courts in Virginia, are different than the courts in Maryland and DC. So it's good to have somebody on your side that knows the legal landscape. We also make sure that we put the appropriate counsel in place from a coverage perspective. You may have a great counsel that you guys work with that have never seen, an antitrust suit. They may have never seen a medical billing suit. They may have, so there's a lot of things out there that they may be great at an EPLI claim, but they may not be great at what about the claim that actually came in the door. So we want to make sure that you have the right people in place. There's also contractual obligations that exist. So you need to look at, the potential of revenue and what you can actually go out and bid on. I know federal contracts and state contracts a lot of times require you to carry this coverage. So it opens up your ability to bid on new contracts. And then finally, and I probably should have put this higher in the list, is attracting leadership. I know a lot of folks won't sit on boards unless there's D&O coverage in place. I do sit on a nonprofit board currently, and I would not be there if they didn't carry D&O insurance. And every year I ask them to review it prior to them binding it. It's just something that, if you want to have somebody sit on your board, they're going to want, especially the people that are truly sophisticated in leadership roles, that they're going to want, coverage in place. All right. So what is your role as a D&O? As an insurance professional, I always look at the total risk management solution. So I think it's important to know what your responsibility is. And I'd like those of you that are on a board or are officers of your organization to really reflect right now and think, when is the last time you read your corporate documents, the articles of incorporation and the bylaws? You have a responsibility to manage the organization in conjunction with those documents. You need to make sure that you are managing the company the way the charter was set. So if you vary from that, or it varies from what you're doing, then you need to go back and either change what you're doing or revisit those documents and maybe update them. You have a duty of obedience, and that obedience truly is to the corporate documents. What I will say is, in general, the directors have the function of appointing the officers, investing in the use of the company assets, approving financial statements, which is really a larger task than many think. They have to make sure they're right, and they have to make sure that you're not making any misstatements or leading anyone on with those statements. And then also the board sets the general direction of the organization. We're an organization that does X, or we want to branch out and do Y, right? So they set the direction of the organization. And then your officers, they manage the day-to-day. Here I have a list of quick links for you in Virginia just to know what the law is in Virginia around the board's responsibilities, and then also it goes into basically all the corporate charter laws. It's not a real exciting read, but I would say if you're on a board, just to make yourself familiar with those laws. All right.
And Drew, do you have a claim example that as we go through this just periodically? So like if the board wasn't staying in compliance, do you have any claim examples that you've?
Yeah, I mean, I've seen a lot of claims that come from the duty, like from the obedience side of the business, and one that really sticks out is actually one that happened last year, and it comes from an organization whose articles stated basically that the purpose of the organization was to assist those with developmental disabilities. It was a really well-established organization, and they decided to branch out and build the facility for those with mental health illness. The venture didn't go very well, and it actually bankrupted the organization. They lost a fairly large contract, and the board was sued by clients that lost housing on the developmental disability side. It was really a bad claim. It was just, those are things, when you change the direction of the organization, if you don't amend the bylaws or change what the corporate charter says, somebody can come back and sue you and say, hey, this wasn't your focus or your purpose. Why were you diminishing corporate assets on it? So I think
that's a great.
Okay, good.
I think that's a great. Unfortunate circumstance, but great example. So when you're looking at the business owners that are on this call, whether they're for-profit, not-for-profit, businesses are constantly evolving, and that's important to note that as your business changes and you're looking at new segments, that you revise the bylaws and understand this obedience example and claims example.
Thanks, Mike. Yep. So next we'll look at the responsibility of the board. I have good faith up here, and you can read what the Virginia Code says good faith is. But I want you guys to look at what is good faith. What does it really mean? It really is your responsibility to always act in an honest and sincere manner. You can't use your role in the organization to further any personal position or beliefs. Nothing political, nothing nothing that is going to line your own pockets. You can't use the position for personal gain or profit. You can't sell or use any of the information that belongs to the company for personal reasons. And you can't distribute confidential information obtained by the company without disclosing it to those you've obtained it from and without their consent.
Hey, Drew, sorry to jump in there again, but self-dealing. Do you have any claims examples for self-dealing or good faith or something around this?
Let me think first. I mean, I've seen a bunch of them. One that kind of sticks out is I had a family-owned large majority of a mixed-use facility. It was residential, assisted living, and some like group homes. But they also owned a construction and property management firm. Who do you think won all their bids for construction and maintenance work? Because they controlled the bidding process and they were involved in the construction side of it, a self-dealing claim arose over the costs that were being passed on to the residents through increased rents. And I believe the big one was that they actually did like an assessment, almost like an HOA would do, for some work, and the case was settled pretty quickly, and well in excess of $1 million I don't think that they wanted to get into the papers what was going on, and I think it was just one of those scenarios. They got caught with their hand in the cookie jar, and it's easy to do, right? I'm in this business. I'm also in this business a little bit, and I really trust myself on this side. But you completely eliminate competition, and that's when problems can really arise. All right. So we look at the responsibility of care. This is really your fiduciary responsibility, and that is to always act in the best interest of the company. You need to make decisions that will benefit the organization and those they serve. When conflicts arise, they need to be disclosed. And appropriate care must be taken to prevent or avoid any transaction that isn't fair to the company. And what that means is if you have a construction company, like we talked about in the last claim, you need to disclose that you also own that construction company to those that are making the decisions. And then you need to bring in alternative bids. It needs to be a decision. It doesn't say that you can't win the bid. It says that you can't unfairly win the bid, right? So it has to be in the best interest of the company. We talked about failure to disclose. We'll see that fiduciary responsibility is a standard of care, just like architects, engineers, any doctors. Every profession has a standard of care. What are you obligated to do? And when it comes to being on a board, you have the duty to disclose fairly, file your corporate documents. There's a lot of responsibility there. And unfortunately, ignorance is not a defense in a lawsuit. So you have the ability to rely on information in your decision making, but you must always make informed decisions, and you need to be able to trust and know the information that's being supplied to you. So if you're using a CPA firm and they're providing the information to you, that's a reliable source. Joe off the street who you hired on day one and said, hey, look at all my books and I'm going to make a decision tonight, probably not a reliable source. There are a number of actions that really can cause claims here. Failure to disclose, and that's not just lying. It's also when you are silent on key issues. If you know there's financial concerns and the organization is unable to perform certain services, if you're in the process of acquiring or disposing of entities or assets, I've seen a number of failure to disclose claims. There was an organization that won a renewal of a state contract that provided services for indigent individuals. The board knew that the company was in financial distress, but they thought the contract would help, kind of continue operations and make their problems go away. So they didn't disclose it to the state when they bid on the contract. They won, and halfway through they weren't able to perform the services because they were running out of money. They weren't able to pay staff, and this led to a massive claim from the state saying, hey, and this is where the D&O assets become in play, right? The company doesn't have money, so they immediately say, hey, you as a board knew that you were going down this road, you didn't disclose it, and that's, it becomes almost a fraud claim of, hey, you can't do this. You need to be upfront and honest when you're making these decisions. Another common one is failure to file the corporate documents, especially for nonprofits. If you don't file your 990s and you lose your tax status, if you forget to renew your corporate license, there's all sorts of things that can happen. And then, we talked about fraud a second ago. Misrepresentation, the last one on this list, typically is a form of fraud. It's when you're knowingly making an untrue statement that another party needs to rely on. So if it's about your financials, about your company's capabilities, and you knowingly mislead somebody, that's misrepresentation, and that's when you're going to see lawsuits arise. All right, so let's look at who is actually covered underneath the D&O policy. you have two different things. You have covered individuals and then covered entities. Every policy is different and should be reviewed pretty closely to determine who's covered. The definition is, again, broken down typically into individuals and entities. Generally speaking, past, present, or future directors and officers, your managers, your trustees, members of the board of managers, in-house general counsel or equivalents, your true management positions are covered. And then there's also coverage for your employees, whether it's part-time or seasonal or leased, temporary or volunteers. ICs, your independent contractors, will vary based on the policy form that you're purchasing. But you may or may not want them covered. Again, it's going to depend on how much you want to indemnify them. And then when we looked at coverage entities, this can be a bit more tricky, right? Coverage is always for the named insured, the organization that's written on your deck page. But if your organization has subsidiaries or operating companies or affiliates, you're going to want to review the definitions of the policy to see, who is afforded the coverage. Typically, coverage will be determined based on ownership, right? So if your organization owns 100% of the other entity, then there's coverage. The way Hanover looks at it and many other large carriers look at it is control. So if you control 51% of the board or you own 51% of the shares, we consider it a subsidiary and coverage is granted. That means that you have the ability to control.
Drew,
go ahead.
Sorry,
Okay.
So I've seen some of this happen, especially sometimes in the nonprofit world, but even more so in the for-profit world, where they've set up all these different entities and different operations under the entities, but you have the same owner with all the companies. And when we talk about directors and officers insurance, they usually want to list, do one D&O policy, doing a blanket, covering all the different entities that they own or have partners in, and they do fit that 51% or more that you had just said there. But do you have any suggestions as far as setting it all up in one policy or not? Or
yeah, I always stay away from the idea of a master policy. And Mike, you had said where control comes into play. I get a lot of requests for adding companies where control doesn't come into play, but hey, the person that we're doing this with, wants us to cover it. I understand where they're coming from, or, we have a 2% interest in this building, so we're going to, add this company to our D&O. Remember, there's a limit, right? And the erosion of limits occurs in bad claims. So if you have a claim where your entity is named and so is this other entity, and it really is the other entity's fault, right? You almost want to be able to wall off your entity from it, because one, you're not going to be able to buy D&O coverage, cheaply anymore. It's going to cost if you have, true D&O claims on your record. But it's more important, when you're looking at the limits. And, when you start talking about personal assets being at stake, if you have a number of companies that are added and one of the companies gets sued and you don't control them, you didn't make the decisions that are being investigated or where the allegations are coming from, why are you picking up the claim? And why are they eroding your D&O limit? Right. So then, if another claim arises that is truly against your entity, there not may be enough money left to really defend your company without eating into the corporate assets. So you need to really be sure that if you're going to add a company, that you do control it and you do make the decisions. Another big reason for that is, in the event of a claim, you're going to be the one making the decisions and working as the named insured on the deck page. That's who I'm talking to, right? That's who the counsel we put in place, they're going to talk to you, right? You're going to make the decisions, not the other entity. And then those folks are going to say, well, wait a minute, this is our claim, and we want to have control of it. It creates a lot of problems if you don't control that entity. So I do, Mike, it makes sense when an organization is really big to split out the policies so you have more limit. But if there isn't control, it doesn't make a whole lot of sense. Will we do it if there's a good enough reason? Yeah, we will. Or if there's enough premium on the table, sure. We'll look at it and we'll do an analysis of risk and we'll try to figure it out for you. But I don't think you're doing yourself any justice when you actually do that. All right, let's look at what's actually covered underneath the policy. I have a picture of an onion here because I always tell people it's like peeling an onion. There's no one sentence that's going to tell you if something is covered or not covered. You really do have to dig through the insuring agreements, coverage triggers, policy provisions, meaning, does it meet certain definitions? Is it something that's intentionally meant to be covered underneath the policy? And then are there any exclusions that would knock the coverage out? So let's first start by walking through the insuring agreements. So D&O is set up different than other policies in the fact that we have sides, and they're done in and normally it won't say, hey, here's your sides. It'll list them out in order, A, B, C, and D. So side A coverage is individual non-indemnified liability. And you'll see side B is also individual indemnified liability. So both of these are for claims when an individual is named. So if you work for ABC Company and they say, the suit comes in and it's, we're suing ABC Company and John Smith, Frank Turner, and they run down these names, side A is going to always kick in, or I'm sorry, it may be side A or side B will kick in for the individuals that were named. And this becomes important, and we'll talk about order of payments later, but we're always going to pay on behalf of side A first and then side B. It really is designed, the coverage is designed to protect the person first. So the difference in A and B is indemnified liability, non-indemnified liability means a claim against an individual where there is no coverage by the entity. So your charter or your bylaws typically state that you are going to indemnify your board of directors and the officers for the decisions they make while working on behalf of the company. That's indemnified coverage. So that's side B, right? So if the company is behind you, we'll pay that second, right? We're always going to pay first when there's nothing behind an individual because we don't want their personal assets at risk. So we always pay the A first. And then B is, again, when there's a company behind you. So what could cause side A coverage? You're in bankruptcy and you don't have the money to indemnify somebody. Or the role that they were filling wasn't in the corporate charter as being an indemnified role. So there's nothing there stating that you have to indemnify them, and you say, hey, they're on their own, they made a bad decision, right? So that's when side A coverage comes in. B, again, is when the company is behind them. Then you get to side C. Those are claims against the entity themselves. And then D really only comes into play when you have companies with securities, right? So not just publicly traded, but this is also private companies. Typically where you have more securities out there, those are derivative demands. So that's when suits are brought by individuals on behalf of the company. So when they win, or if they win, the money doesn't go to anybody, it goes back into the company. Basically, if you think your board has squandered assets, and it may even be you think that they've gone and, overpaid themselves and you're trying to recoup that money goes back into the company, not to the shareholders. All right, so coverage triggers. Let's first look at it, the fact that it is claims made coverage. So claims made means that coverage is triggered when the claim is first made, not when the incident occurred. So it's not an auto accident where we say it happened on January 31st, whose coverage was in place. it's more of a, when the suit comes in or the letter is sent to your company with a demand, that's when the claim is first made. When somebody is demanding something of your entity in a legal setting, that's when the claim occurs. So if you buy coverage today, but your board, has been making an ongoing mistake, right, and it hasn't come out yet, then tomorrow when that suit comes in claiming that it was done, 6 months ago, it is typically going to be covered unless there's a prior accident on the policy. The reason this coverage is written on a claims made basis is that the allegations typically manifest over time. There isn't, an incident like an auto accident or a fire that we can point to and say it happened on this date, right? It is something that takes time to develop over a period of time. It's always important that when a demand comes in that you do submit it to your agent and to your carrier, and they'll determine if coverage is afforded or not. So the other really big coverage triggers come from your definition of claim, loss, and wrongful act. So first, let's look at the definition of claim. It will tell you whether the allegation, demand, or notice that you received makes up or constitutes a claim. Typically, the definition will include written demands for monetary, non-monetary relief, civil or criminal proceedings, administrative or regulatory proceedings, requests for mediation or arbitration. So that's kind of where we start, is does the allegation or the notice that you've got meet the definition of claim? And then we'll move on to loss. The definition of loss will determine, what's covered or recoverable under the policy. Typically, this includes the cost of defense, monetary judgments, settlements, compensatory damages, punitive and exemplary damages, civil fines and penalties against an individual. But I always tell people, and Mike knows this, I've had this conversation with Mike a number of times, I think the most important part of the definition of loss is what loss doesn't include. There's always a piece that says loss does not include. And I always say, that's where the rubber meets the road, right? You have to look at and see what a carrier is taking out of the definition of loss. I've seen some pretty horrific things be taken out, like all civil fines and penalties, so individuals don't have coverage. It can get kind of hairy and dicey. Then lastly, the definition of wrongful act. The good news is a D&O policy is kind of like everything in the kitchen sink, right? The policy typically states all acts, errors, omissions, misstatements, misleading statements, and it goes on to list a large laundry list of what's covered. I always tell people that I refer to the D&O policy as everything is covered but what's excluded. So it's really important to know your exclusions and to know the base form that you're working on, and that's where somebody like Mike comes in handy for you. So as you can see, coverage determinations are not always easy. You have to review each claim separately and to make sure that there is coverage for the claim. All right. So let's look at the policy provisions then. And I've just listed a couple up here, ones that I look at when anybody says, hey, can you review coverage for me real quick and just tell me if I've got my, my basis down. I always look at allocation, right? And that's used to determine what portion of a loss will be paid. Most claims or demand list more than one allegation. It doesn't say, on this date you misrepresented this fact, right? They normally give you a laundry list of allegations of things that your organization did wrong. So sometimes there'll be covered loss in there and sometimes there'll be uncovered loss. Allocation will determine what the carrier pays and what the insured pays. Hanover and some of our larger competitors typically focus on 100% of defense allocation, meaning we cover all of the defense for every allegation until all of the covered loss is gone. So if there's coverage for anything, if there's coverage for anything, we defend everything, right? And then when it comes down to truly settlement or payments being made based on loss, right? When the court says you owe, X amount for this, X amount for that, that's where we will allocate loss and say, hey, this was a covered loss, we'll pay that. This was uncovered, that's yours. And it'll work through. And it's good to know that settlement indemnity is typically allocated. One thing I will always caution you is make sure that your exclusions don't change allocation or any of these other terms for the worse. If they change for the better, that's awesome. Severability. The severability exclusion defines who the conduct exclusion applies to. It's common that if someone lies or misrepresents exposure on an application, coverage won't be afforded to them, but severability defines who it will be imputed against. So typically it'll say, like, hey, it's not, there's no coverage for this individual who lied or was fraudulent, but coverage for everybody else stays in place. And it's common that if their misrepresentation is made by a director or officer, then typically the coverage for the entity is wiped out. Hammer clause. Hammer clause is a piece of the defense and settlement clause. It's the carrier's need of consent to settle. So we can't settle a claim without your prior authority. But the hammer clause gives us a little bit of negotiation power with you to say, hey, remember, if I can settle this for $100,000 and right now, and you don't want to settle it and it goes to trial and it ends up costing $200,000, the carrier is always going to pay that initial 100, and then the additional 100 on top of that, because it costs us 200 instead of 100. That additional 100 is going to be split 80-20. The carrier will cover 80% and the insured will cover 20%. It really is a negotiation tactic. In my 12 years of management liability, I have never actually seen a hammer clause invoked. But it's there as a tool, and they're negotiable, right? So there's something where Mike frequently comes back to me and says, the base form says 75-25. Can we do 80-20 or can we do 85-15, right? So it's a place where we can negotiate. The reporting clause is a big clause and something that you should always be familiar with. That goes over the timeline and the guidelines for when you have to submit a claim to the carrier. If you don't meet the reporting guidelines, sometimes the claims can be denied for late reporting. This is really based around if a claim comes in, we want you to tell us. We don't want you to go hire counsel, start defending yourself and making decisions, and then you lose the case and you come back and you hand us a bill and say, oh, by the way, we lost this case. Here's what you owe us. We have the duty and the right to defend, so we want to be involved in the claim and we want to make sure that we're making decisions in conjunction with you, and we're also there in an advisory role. We're not just looking out for our own money; we're looking out for your money too. So it really is a partnership and a team role. Excess side A, we talked about your insurance agreement. Side A is when there's no other protection for an individual or an officer that's being sued. Excess side A is coverage that can be added on. At Hanover, we typically add in $500,000 without even being asked. So if you buy $1 million limit and that gets eroded, there's an additional $500K that sits out there that is only for the officers, right? So if there's a claim against them personally, we want to make sure that their personal assets never come into play. And then the final one is rescindability. Carriers rescind policies typically when, the carrier was defrauded. Again, we were lied to, we weren't given a complete truth, and, a claim arises, thankfully, and and I'm a big proponent of this, our policy is non-rescindable. We believe severability is enough, right? If the person that lied to us is out, we have no reason to pull the whole policy and make it so that there isn't coverage for everybody else. All right. So now we kind of looked at, we got into who was covered, and then we kind of moved into the key terms in the policy and some definitions. I really do. Wait a minute, I missed a spot. I'm sorry. Exclusions. I want to really walk you through exclusions. This is what's not included in the policy. So there's always going to be a section that says this is excluded. There are very common exclusions that you should not be, concerned with, and typically those exclusions are there because there's other policy forms that you buy from your agent to cover those things. Property damage and bodily injury, right? We're not picking that up because your GL does that, and your package policies are going to do that. But you need to know not just what the exclusion is, but who it applies to. Exclusions vary between carriers and how they apply, right? Like employment practices, they're excluded underneath D&O, but because we offer, to buy employment practices. But if you look at our D&O policy, most carriers have the employment practices exclusion under D&O applied to every coverage part, everything. Ours only applies to the entity. So if you don't buy D&O coverage and an individual is sued, we're going to pick that up because we don't want the individual's assets being applied. Right, so just make sure we'll talk a little bit more, I think Mike will get into as well, exclusions that are big on the policy, and to know whether it is truly applying just to the individual, just the entity, or does it apply to the entire policy. And then endorsements, this is by far the largest variance in your policies between carriers and between individual insureds. Management liability is really becoming more commoditized. Many of the base forms are similar. There are some difference, but the biggest variance, again, is going to be under the endorsements. Endorsements are typically used by underwriters to modify coverage by excluding or granting coverage. They also broaden or restrict those key provisions that we talked about. And, there's some endorsements that are inevitable based on your operations. Right, if you're an architect and engineering firm, we are 100% going to exclude your professional liability. But if you're a small foundation, a nonprofit foundation, where you really don't have any professional liability exposure, we leave it in there because it doesn't really, the likelihood of a claim is so insignificant. You probably don't need to go buy a professional liability policy. It can just be underneath your D&O. But in some cases, endorsements are negotiable with your agent. It may come at a cost if you want something removed. If you want coverage granted or added, it can be done. Talk with your agent about it. He or she may also have thoughts on what can and can't be added, and push you in that direction. All right. So sources of claims. Claims come from a really large, diverse, how do I say this? They come from everywhere, and it's tough when you manage a company to understand all of the risk and all the liability that you incur on a daily basis. The only reason I know is because I see it and I see all the claims come in. I've worked with a lot of experienced agents, a lot of people that have been in the business for a really long time, and they'll tell me that, hey, I have a privately held firm, they have one owner, I have no need for D&O insurance. Or, hey, it's family owned, and it's been family owned for generations, there's no securities, I don't need D&O coverage. That is the farthest thing from the truth. Claims don't just come from shareholders or security holders. You'll see it's one of the items listed on the slide, but it's not the only place, right? So clients dissatisfied with your management or oversight of the operations. They feel money was squandered that could have provided better services. They don't feel that you were upfront in your bidding or negotiation of a contract, right? So clients are a good source of claims. Competitors, claims from competitors in this realm typically claim that you've interfered with their business or their contracts. You've somehow, created unfair competition, or you've stepped in and really messed up their business intentionally. Creditors, those that lend you money or that owe you money, or that you owe money to. If you're having trouble making payments, if you lied to them when securing a loan or provided false information, it could also be suppliers, right? People that are sending you supplies that you have to pay for, and they do it on a credit basis. Employees is another one. When their benefits or retirements are put in jeopardy, whistleblowers. We talk about regulatory claims. That leads right into the regulatory and government claims. Government agencies are always pursuing regulatory compliance. Claims can be brought by local, state, or federal bodies. These claims are extremely tough to defend, and they can also be brought under seal. That's something that really, I think it's good to get out there. Organizations won't know that a government agency is investigating them or bringing charges for up to 90 days if it's done under seal. So they go to a court or a judge and they say, we believe that they're out of compliance for these reasons, and we want to investigate them. We want to file these charges under seal. So they basically file the charges under seal. You have no idea the charge has been filed against you, and they start their investigation. They start sending you letters, asking you questions, maybe conducting an audit, and you think everything is normal, but really you've already been charged with a suit, and you just don't know it yet. Some more common suits arise in the government arena from state or federal housing or development authorities, Medicare and Medicaid claims, claims of breaching fair lending laws, Department of Labor claims, but there's a whole litany of other regulatory bodies that bring suits. Next on the list, you'll see shareholders. This is truly what I believe everybody thinks of when they hear D&O coverage. They think of the shareholder suit, right, where the share price is dropping, or individuals are losing money and they're unhappy with the direction of the organization, so they sue. The policy will typically limit suits being covered to those shareholders that are not on the board, as the board's making the decisions, or not majority owners, right? If you're on the board or you're a majority owner, we're not going to cover suits. It doesn't mean that the claim can't be brought. It just means that the D&O policy isn't going to cover it. And then finally on the list, you'll see vendors. Vendor claims typically appear when your business has an adverse impact on theirs. They feel that they were lied to about the size or scope of a project. They don't feel that they're being compensated properly for their time or their services. We do see vendor claims frequently. And then if we look at, so those were sources, right? So those are who brings the suit against your company. Here, we'll look at the types of claims. So what suits, so that's who brings them, and then what suits do we typically see? We see a lot of antitrust violations. Antitrust laws are governed by the Sherman Act. They're used to protect competition and prevent anti-competitive conduct in an industry or between companies. It prevents businesses from colluding, price fixing, restraining competition. In healthcare, antitrust enforcement is done by the DOJ, and it's used to benefit the end user to really help contain the costs, improve quality, and expand choice. It encourages innovation in the healthcare industry. So it's just antitrust. When I said, I mean, it applies to all industries, but healthcare right now is really being targeted.
Right. Drew, didn't you you were telling me about a claim the other day with antitrust? Do you recall what I was referring to?
It wasn't in the healthcare industry. It was a nonprofit. It was actually it came out of the alcohol and beverage industry, and it was a price fixing allegation that on a state level, distributors of alcohol had kind of gotten together and not fixed vodka prices, but moderated them to a point where it gave the impression of price fixing. I think about it from a margin perspective. If everybody in a town is selling pizza, and you're fighting, to have the cheapest slice of pizza, so that way people come to your shop, you're not going to make any money on the margin side. So all the pizza places get together and say, hey, let's just set the price of a slice of pizza at $2.50. Right? Seems fair, but it just wiped out competition. So that's price fixing. And the claim that Mike I was telling you about was a liquor distribution price fixing claim, and it looks like it's going to have some real meat to it from a loss perspective. It's not a Hanover claim. It's one that somebody in the industry that I know very well was sharing with me. But then we can also that's on the antitrust side. Contractual disputes. Most D&O policies will limit what's covered underneath your contractual disputes, and that typically is going to be, we're going to cover any liability that would be there without the presence of the contract, right? So when you think about a contract, you have to make 1,000 widgets by X date, right? If the claim comes in that, hey, you took my money and you never made me any widgets, well, yeah, that claim would exist without the contract, right? Because you took the person's money, you need to produce something for them. It's the date clause that it's, hey, you delivered them on 1/1 instead of December 15th. Well, without the presence of that contract, that claim wouldn't have existed. So we typically look at it in that sense. What is your actual liability, not what the contract itself brought on. Failure to disclose. We discussed this early. They're fairly common suits. Again, it's when the board stays silent on key issues. False advertising. This could be on your website, in material that you put out there. Typically, your publisher's liability is going to be libel, slander, misinformation that you're putting out there that isn't true. And then if we look at improper billing practices, this is really big in the medical and human service industries. I'll take a minute just to kind of touch on it. These are normally brought as fraud cases, and they're looking for bad actors, right? The Medicare and Medicaid claims, they're looking for those that are doing it intentionally. Now, if they find out that you've been doing it unintentionally, they're still going to want the money back, but it's not going to bring any criminal aspect to it. In my opinion, most of these claims really do stem from poor documentation on the part of the insured. You need to make sure that your files are up to date and noted properly on all of your clients, right? So all your clients, your customers, your patients, everything needs to be documented. I see a lot of the claims that arise where it comes from, you performed, this service for somebody over a long period of time, but you didn't document 6 of the dates that you saw the person. Well, Medicare and Medicaid is saying, hey, you billed me for this, but I don't see this. Oh, we just forgot to put it in the file. Well, if it's not in your file, we're not paying you for it. So some of those claims aren't fraudulent, but more documentation. You need to document why you're prescribing a drug or why you're doing something. It's no different than being in the doctor's office, right? If you're an institution, whether it's elderly services, services for the developmentally disabled, any human services industry, if you're taking Medicare and Medicaid money and billing, you need to document properly. It's not the responsibility to hire a third party to do your medical billing. It's not their responsibility to document your files, and having them doesn't, having a third party doing your medical billing doesn't alleviate you from liability. And there's a lot of different types of claims that come up, and I'll just list a couple that I know off the top of my head. There's billing for services that aren't rendered, billing for non-covered services as covered services, right? You think, hey, this isn't a cover. I need to do something that isn't covered. I'll just bill it as something that is covered. Misrepresenting dates of service, misrepresenting the location of service or the provider of the service, waiving deductibles and co-payments. And this is a big one that costs Medicare a lot of money. A lot of times they'll bill a service, but they don't collect the copay. There's a reason that Medicare and Medicaid list copays for things. Incorrect reporting or diagnosis of procedures. This is more of like the bundling and unbundling claims, where you bill for a surgery that includes all of the services provided in the surgery, and then you also bill all those services individually, right? So you're double billing, you're double dipping. Incorrect or overutilization of services, meaning you don't have to provide the service, but you keep providing it so that you get paid by Medicare for it. Corruption, which includes like kickbacks and bribery, and then false or unnecessary issuance of prescription drugs. Those are the big ones that I can think of at the moment. But this is big in my world right now. There's a lot of Medicare and Medicaid claims flying around. I know, Mike, we don't have to get into the details or the specifics because I know it comes out of Virginia, and it's something that's closer to home for you guys. But I know that you recently saw one that was fairly large.
Yeah.
What was it, $3 million?
Yeah, it was a little over $3 million, and what people also don't realize is that it was a cumulative a number of years that this happened, and there's that look back period where they're going to go back and back and back until they determine when it started, and they're going to want their money back for all of that plus interest, and like you said before, fines and penalties, and so it was pretty catastrophic.
Yeah. So I mean, these claims happen, and they're expensive, and what people don't realize is, the claim, the number that everybody sees on the front page is at $3 million. What they don't see is the additional $1 million it costs in legal bills, right? Because you're paying an attorney to go through all of this with you, to defend you in court. I mean, there's a lot of cost to it. And that's why I always tell people, if nothing else, a D&O policy is defense, right? When a claim happens, we're there to step in your shoes. Well, let's keep going down the list. I don't want to go too long on this. But if we keep going down, so, we talked about misrepresentation and fraud already. Personal injury, I talked about that a minute ago. That's your libel and slander, putting untrue or fraudulent information out about your competitors. Tortious interference, that is, when you're going to see claims from your competitors, that is interfering with their business, whether it's undercutting contracts or unfair bidding practices, going after their grants or their clients intentionally. I actually had a really bad one. That was a manufacturing claim early on in my career where somebody hired the director of sales from another manufacturer, and he started going after all of his old clientele. And Virginia is a right-to-work state, which immediately became the carrier's defense, right? Hey, this is the right to work. He has a right to work. He has a right to do business. He's just trying to do business. And they asked for, in disclosure, they asked for the sales sheets, right? Who was he contacting? What was his call list? And when they went back, I think it ended up being over 95% of the businesses that he targeted were from his prior employer. So if they had looked at it and said, hey, it's 50-50, or yeah, he is targeting that business, but it's only 10% of what he's going after. He's also, that's a right to work when it's in your scope of business. But when you are only targeting that other company's business, that's tortious interference. And they lost that case pretty big. And then again, unfair competition. If you're undercutting bidding, if you're, if bidding rules are laid out, whether it's a state or government contract, and you're doing things that are against that laid out procedure, you'll get hit with unfair competition claims. All right. So let's look at a couple of claims that, just to give you an idea of how a claim actually happens or occurs. The first one is, we talked about the Medicare and Medicaid, the billing and coding claims. There was a facility that in 2011 underwent a Medicaid audit or Medicare audit. I use this claim because it's not a huge figure on the dollar side, but it's a recent claim, and it made headlines, just based on the fact of them lying. So the facility was providing behavioral health services. They underwent an audit, and the state had hired a CPA firm that were there to investigate the billing practices, right? Now, the CPA firm has incentive to find unfair billing practices, right? They're not being hired to not find anything. So they have incentive to really dig. In this case, they found that improper codes had been used. As a result, they believe that Medicare overpaid for services and that the facility was not entitled to the payments that they did receive. So when the state brings the allegations, there's always the allegation of fraud, whether it's fraud or not. And in this case, the insured said that the services were rendered and coded properly, but that the documentation of the patient files was incomplete. So they were able to escape the fraud side of it, but they were found in violation of the State False Claims Act, and it was a costly suit. As the defense was, I think it was right around $250,000, even though the claim was only for $54,000, right? So it's not a big dollar amount on what they had to pay back to Medicare, but it cost them $250,000 to get there. So it shows that the cost of defense sometimes can be worse than the indemnity itself. So not a terribly bad claim, right? You're looking at $300K, but again, having the D&O policy, if you don't have the D&O policy, you don't know what that defense number or what that indemnity number is going to be, because if you don't have people helping you that know what they're doing, typically the claim will get away. All right, so claim number two, this is, a kind of like a worst case scenario. This is one that Hanover was not on. It's a fairly well-known claim in the industry, but two teens were able to get out of a youth facility. They began breaking into vacant homes on a nearby lake. One of the houses had been occupied by an elderly couple, and the teens brutally murdered them. The suit was brought against the facility and named every board member and every officer. The suit alleged breach of fiduciary duty, failure to provide adequate and proper supervision, failure to provide timely notification to law enforcement, and negligence. So you can see that it's not one allegation being made. They name a number of allegations. They sued everybody they possibly could sue. And what ended up happening is kind of interesting. Prior to going to court, a large majority of the board members and officers decided to settle out of court through the carrier, and they settled for $5 million, which was the policy limit. So the policy just wrote a check and got them out. the owner of the facility didn't want in on the settlement. He didn't believe that they had done anything wrong or that there was any negligence there. And the attorney, tried to use that the facility was guilty because most of the board members settled, right? So they knew that that was, going to be against them. That may have actually saved the case because the jury in the case knew that the family members had already received that money, right? So the jury had said, wait a minute, you've already received $5 million for this. And the organization was not found guilty. Defense costs were in excess of $350,000 now. So the carrier paid out the full amount of the policy up front, but it's one of those situations where it's a terrible, terrible tragedy, but things do happen, right? This organization took troubled youth and put them in a facility to try to get them help and get them, the resources needed to then become productive members of society. And in this case, it didn't work, and they did get out, and it's tragic. But I put it up there to show you that, this was a small organization. This is not a big organization. So big losses can happen to small companies. It's just good to know that, when you're talking with Mike or whoever your agent is about limit, make sure that you really look at what you're carrying and what your operations are. All right. So when you look at a base form review, I briefly discussed endorsements earlier. Most policies will have the greatest variance in coverage. The endorsements are where the variance is, but when looking at gaps in coverage, first you want to review the base form. And I have up here, we want to look at the key definitions. Are they broad enough? And are they competitive in the marketplace? Right. So you want to know what your current carrier has, but also what other carriers have. And that's where a good agent, like I was saying, Mike comes in. And are there any major coverage triggers missing in the definitions? That's a big thing to look at. Make sure that claim is broad enough, that the definition of loss isn't excluding anything that really should be covered. But also then look at what entities are covered. Is everything that you want covered? And are you covering anything that you shouldn't be covering? And then also look at your key provisions. We talked about them earlier, but is there an order of payments? Are we making payments on behalf of the individuals first and then moving on? Is there severability for innocent parties? When it comes to your allocation provision and any of these provisions, make sure that, we'll talk about endorsements later, but make sure that, the endorsements don't change those provisions. And then also look at your exclusions for or absolute wording. And that's a really big one. So for wording is if we say, like our exclusion for bodily injury and property damage, right? We're not going to pay for any bodily injury or property damage. Absolute wording would be, we're not paying on any claim based on arising out of or any way involving bodily injury or property damage. So it's important to make sure that the exclusions where you can have forwarding, that's what you have. Because if you have absolute wording, there may be a management claim that comes up. Like look at the claim example I gave you on the runaways. If you look at that claim, every one of those claims, negligence, I'm trying to think of all the claims that were there, but everything that was there arose from a bodily injury claim, right? But because if there was absolute wording, a lot of that may be, excluded because we say, hey, it's arising out of. So just make sure that, somebody is looking at that and knows the wording behind the actual exclusions. All right, so here, and then endorsements of coverage again. endorsements aren't always doing just what the title says. So make sure that you know what the endorsement is doing. Is it adding coverage or is it excluding it? A lot of endorsements do both, and then change different parts of the policy. So just know what is being changed. Is the endorsement sublimating coverage that may already exist? A lot of times I see people say, well, X carrier is giving me $250,000 of privacy protection. And all I can say, wait a minute, but that's something that's included in the policy, right? So you end up losing, right? They end up sublimating the coverage down. So what they're really doing is capping their exposure where it's typically covered. So you want to know what the endorsement is doing and what exposures you have and how they're being addressed. I know I've given you a lot of information, and this is a lot to take in. I hope everybody gets a few takeaways from this before I turn it over to Mike. But Mike, thank you again for the time. I truly appreciate going over this and sharing some of the knowledge that I have. I think it's a really misunderstood coverage, and I think it's a place where if people are more educated and understand the topic better, you'll see better protected companies in the long run, and that's what our goal is, right? To protect the companies we insure.
Right, and I appreciate your time doing this, and a lot of really, really good information here. Probably diving deeper than most of the insurance agents out there even know about. So the key is arming you with information so you can make better decisions moving forward. Typically when folks come to me and ask for a quote, you don't necessarily want to focus in on bottom line costs. It's what makes up that premium, not what is that premium. So all the things that Drew just went over, some of that coverage could cost more in premium. Some you just simply have to ask for it. But I know a lot of you on this call already have directors and officers insurance, but I would challenge you to ask your agent, what's not covered in this policy that maybe I'm exposed to. So maybe, rather than getting overwhelmed with all this information and worrying about what is covered, like Drew said, everything's covered except for what's excluded. So maybe focus in on what's not covered that could potentially happen. And then constantly, readdress it every year. If you're continuing to budget, and it's something you do not want to be paying out on your operating balance sheet and income, then maybe you can budget for it in the future so you can shift that risk, back over to the insurance company. But I think a great spot to look at if you're doing this yourself is the definitions and exclusions, like Drew talked about, and really, talking with an insurance agent that knows this specific coverage, because most agents, like I said, after taking over this call from Drew, that most agents aren't really that familiar with directors and officers insurance. It's more service level. But so if you can partner with an insurance agent that really knows this coverage and all the sides and exclusions and endorsements, they're typically going to help you obtain better coverage and be able to explain it more in layman's terms so you can understand it better and make those decisions. So, outside of the directors and officers insurance, one other item that I wanted to refocus in on is it's often a great idea to have the insurance company that's doing the directors and officers insurance to also be able to provide the general liability and some of the other coverages. So that can't always happen. But sometimes if the pricing is similar, or maybe you may even want to consider paying more premium to have the same liability insurance company, writing the general liability as the directors and officers, or the employment practices liability, because, like one of Drew's claims examples he talked about, maybe there's coverage for the entity, but not the individual, or vice versa, under the D&O or EPL policies. So if you had one carrier doing both, then the claim is going to be a much better situation and better outcome.
Yeah, Mike, I would be remiss for not commenting on that. And I hope you learned that from me, because Mike is 100% spot on there. When a claim comes in and it could potentially be something under a D&O or under a GL policy, if it's two different carriers, they're both going to say, no, that's him. No, that's him. They're going to try to push you away. Whereas if it's the same carrier, we're going to have that argument internally where we're going to send counsel and we're going to work on the claim, but we're going to bicker internally who's paying for it, right? So you'll never see any of that. Your claim will be paid. You're not going to be going, knocking on different doors trying to figure out who's covering this claim for you.
Yeah, I absolutely appreciate you jumping in and saying that as well. And some of these coverages you're just either not going to be able to obtain in the marketplace for whatever reason, or it's just cost prohibitive. So I also would challenge you to understand your exposure and try and figure out ways that from a risk management standpoint you can prevent the claim from occurring. So monitoring your bylaws and updating them as needed, and there's loads of things that we can talk about that you can do that will help reduce your risk. And if you can't obtain the coverage, at least do the best you can from a risk management standpoint to help mitigate that risk. Insurance companies are also utilizing predictive modeling. They're using that term, so they're trying to understand where the claims are coming from, and they're trying to find out, you, the business owner, the policyholders, what are you doing to prevent those types of claims from happening? So that's evolving as the case law comes out and these new claims come up. So what are you doing to show that you're doing best practices? That's not only going to reduce your company risk, but also in the end we're trying to reduce the cost of these insurance premiums that you're paying out. So predictive modeling is constantly something that you should be monitoring with your agent and looking to see what are underwriters looking for, so you're a preferred risk, and ultimately reduce your premium and risk. So anyhow, I think that we've covered the basis for today. And Drew, unless you had anything to add?
No, not at all.
Okay.
I appreciate it, Mike, and thank you.
Okay. Well, I will conclude with this. We're going to be talking about some other topics as well, so keep me informed of any other topics that you're interested in, and we can dive into those further like we did the directors and officers insurance. If you had a specific question on directors and officers insurance, I love what I do. I think I'm one of the luckiest men to love their job, and I really don't see this as a job. I love just talking about it. So if you want to reach out to me at any point, here's my cell phone number and my email address, and happy to talk to you about your specific question and dive into it further. And ultimately what we typically get hired for is we do an insurance policy assessment. We'll do that at no cost, and we'll be able to dive into the coverage and the exposures for you more deeply, and see if we can help you with some advice and improvements on moving forward, whether you hire us or not. So again, thank you everyone for your time and the opportunity to talk about this topic, and looking forward to talking with many of you in the near future. Thank you.